Good afternoon, everyone. Welcome to the next session. A slight change of speed here, going from the CBDC's discussion, which things seem to take time, and we've been talking about for many years. And we're going to switch over to the fast-paced crypto trading and investment world, and get inside the minds of three asset managers who've been in this space for a while now to learn what they've seen and what they expect to see over the coming months and years ahead. So delighted to be joined by three excellent speakers, and I will let each of them introduce themselves to you. Alfonso?
Sure. Alfonso Delgado, Managing Director of Silver Ray Capital. We're a hedge fund manager founded in 2015 to focus on digital assets. We have a long buy strategy that we've been running for 10 years now, and we've seen many different ways of innovation in this market and changes to the market structure and new opportunities open up for trading, which I'm happy to share in the course of this session with you guys.
Hi, how are you doing? My name is Wilfred Daye. I'm the CEO for Samara Alpha Management. We are fund-of-fund business, really a platform in cryptocurrency space. So we run fund-of-fund. We run as separately managed account, as well as with senior managers in the ecosystem. I'm very excited to share some of the ideas with you folks. I'm from New York, so I'm a little bit jet-lagged, but hopefully it will work out.
Afternoon, everyone. I'm Barnali Biswal. I'm representing Hilbert Group and Hilbert Capital. We are a crypto-focused firm. We run a quant hedge fund alongside other crypto niche businesses. Looking forward to the session.
Perfect. Thanks so much, Barnali. Just say my name is James Delaney. I work for AIMA, which is the Alternative Investment Management Association. We're the world's largest membership association for the alternatives industry, representing fund managers who collectively manage around $4 trillion in hedge fund and private credit assets. So, into the conversation we go. We thought we'd kick off with sort of the evolution of trading and investment strategies in this space. Keen to sort of better understand from our panelists how they've looked at sort of strategies, instruments, how things have developed over the past 10 years or so. So, Alfonso, I wanted to turn to you in the first instance. How you mentioned your firm has been operating around a decade now. It'd be great to know sort of in your perspective how things have evolved in this space during that period of time, from when you first set up shop to where we are today.
Sure. Back when we started in 2015, everything was a big challenge. You didn't have service providers like fund administrators or auditors that really understood the asset class. You didn't have properly regulated venues that you could trade with, so that was also a challenge. Custody, there weren't any institutional grade custodians, and even the fund landscape was very, very small. I think when we started our investment firm, there were probably only 2 or 3 other investment firms that were investing professionally in digital assets. So it was all very new. And actually, our first trade when we acquired some Bitcoin was a purchase that we did directly from the US government, from the US Marshals, because at the time, that was the cleanest way of acquiring digital assets, or Bitcoin in that case. I think the market structure has evolved a lot over the years, and I'm sure we'll get more into that. Now you have a regulated ecosystem of counterparties. You have professional custodians. We're proud to work with Coinbase on that front. You have a lot more funds that have come to market and explore different kinds of strategies. Some have become much more quantitative in nature, which you are able to do now thanks to the launch of derivatives and ETF products. There being more data and more liquidity to trade more actively. So the range of strategies that you can launch in this asset class has also widened over the years. So there's been a lot of evolution overall, as I mentioned, across the fund landscape, market structure, and kinds of strategies that can be deployed.
Brilliant. Thanks for that, Alfonso. So we've seen maturation of the market, sophistication and investment strategies as well. Wilfred, just wanted to, if you had any further comments on that point, but also wanted to ask you specifically around data and how you've seen that sort of evolve.
Yeah, so supplement Alfonso's comment, I think this year after post-FTX, we see a systematic shift, a huge shift in the marketplace where people care about the counterparty risk a lot. So not only do we have the custody out there like Komainu or Copper and so on, but we also have something called a tri-party arrangement on-chain. So this is basically off-exchange settlement, and that's been very fairly popular across institutional investors. So it's really a tri-party, old days, but it's on-chain crypto. It's a crypto version of a tri-party agreement. We see that grow, especially in the U.S. institutional side, quite significantly over the last a year and a half. And that's, I just want to supplement that to this conversation. On the data side, we have Kaiko of the world, get into level 3, level 2 data, high frequency order book data, and so on and so forth. So a lot of very sophisticated data service providers out there, including on-chain, DBank. So the whole ecosystem is actually pretty rich from data perspective. We also see traders utilize order book data, using machine learning, different AI approaches to discover alpha, within data set. So this is a very, very rich environment today.
Perfect, thanks. Barnali, anything to add on the comments that have been made
No,
already?
I think everyone covered it. To Wilfred's point on data, I think that's a very important point to underscore, especially when you compare vis-a-vis the traditional markets, the ubiquity of data and the ease of access that you have, especially for tech-savvy, outfits. It's actually a million miles ahead. There is no information or very little information advantage in this market.
Yeah. So I just want to supplement the difference between traditional market data versus crypto market data is that traditional market data you pay arm and length for it, for it. So for instance, if you want to use foreign exchange data from Reuters, you have to pay for that. But in cryptocurrency, you can actually directly plug into the exchange and get order book data directly, or you can do your work and then actually scrub the data, or you can go to Kaiko, right? So there's a lot of options for crypto traders in this area.
Thanks, Wilfred. And then Barnali, just wanted to get your specific thoughts on the evolution in terms of counterparties in this space, and Alfonso touched upon it as well, but how have you seen that evolution in the last decade or so?
Yeah, I haven't been in this industry for a decade, but half a decade, that's a long time in this space. But I think it's a very hot topic, right? Like when it comes to any kind of newer markets, you would have counterparty risk at the top of any investor allocator's mind. So from that point of view, which is typical in any other market as well, is that you do see maturation over time frame. One of the things that was very bad, but also weirdly very good, was FTX, because it just fast-tracked a lot of the infrastructure-related lags that were existing. That is not to say everything is fully fixed, but it's not fully ideal state, even in some of the most developed and advanced markets. Stuff that I would highlight away from sort of high-quality service providers, custodians, trading venues, etc., are things such as allocators are way smarter and much more diligent compared to 2 or 3 years ago even. And then the second point that I will point out is, it's kind of the industry poster child is Clearloop, but there is definitively a much bigger, broader discussion around tri-party settlements, other kind of off-exchange solutions, which is only but healthy for the industry as a whole.
Brilliant. And we'll come on to talk about sort of how you see things developing going forward, particularly with the US change of position on the crypto markets there. But just before we move forward into that discussion, in terms of sort of lessons learned, is there anything any of you would sort of highlight looking back over the last however many years you've been in the space that you would mention?
Sure, our strategy has evolved over the years. As you can imagine, over the course of 10 years, the market has evolved a lot. When we started, it was more of a liquid venture proposition. You didn't have the data, the liquidity, or derivatives to really actively manage the risk in your portfolio. But now all of those constraints have gone away, and we've been running a much more actively traded, more risk-managed version of our strategy, and we've seen significant success in the improvement on the risk-return profile. So we've learned to incorporate these tools of derivatives and data to build models and do more active trading and improve the risk-adjusted returns of our portfolio. That's on the market risk side, where we've been able to reduce volatility and drawdowns for investors through these tools. On the credit risk side, we've always been very conservative with counterparties. We haven't had any issues with exchanges or hacks over the years. But I think an important lesson there is that the risk of extreme losses in this asset class can come from not only market risk, but also from these non-market risks that people tend to overlook because they're not as prominent in other asset classes. So I would say that for anyone participating in this space or looking to enter, it's very important to focus on the operational credit risk side of things and not to overlook those risk factors because they can also be the cause of pretty extreme losses.
Yeah, so within our portfolio, we focus on market neutral strategies. So the market risk itself kind of removed away by the construction, effectively. So we care a lot more about operational risk, right? The operational risk. I mean, people make example of like FTX and so on and so on. But if you look back on the traditional financial world, you got Carvel, you got a lot of fraud, borrowings issues with Nick Leeson and so on. So there's a history of operational risk realization, if you will. So the fraud risk is sort of it's a human nature, right? So you cannot hedge that. So we do diligence. We do diligence on the manager itself, the company. So we've done a whole lot of diligence. We focus on the special, some of the deep dive into the operational diligence, a reputation, check and so on and so forth. So that's very important. I'm always joking about the cryptocurrency. It's more like an industry where you'll step five step forward and then 3 step backward, right? So, but that is also true in traditional finance. So there's some of the operational risk you cannot hedge. So that's something that people need to focus on.
I mean, I can't add much more to the operational risk side of the things. That is clearly number one. But to your specific question, lesson learned, I mean, all three of us come from very long investing background, but like when you spend time in a newer industry / market space, it really needs to register in your head that, you're very early in the long term, but you're probably a bit too early in the short term. And then constant reminder is every time you would have any kind of like operational / counterparty related issues or even, expectations around asset class / niche development, in the local, you're almost always overshooting or over-expecting, and you're almost always under-expecting in the sort of more intermediate to long term. So just thinking about allocation, portfolio construction / risk management in that framework is something that I've had to relearn over and over again.
And maybe one more thing to add. We had to develop a lot of our own internal infrastructure for tracking balances and trades because, frankly, service providers that cater to traditional finance weren't really developing products that had the nuances of this asset class in mind. So we ended up building our own PMS and all of our internal systems. I know this is also true about your system and perhaps also your firm. So that was initially a challenge, but as a result of that exercise, we have quite a robust internal set of tooling that we've built over the years.
Brilliant, thanks, Alfonso. So I wanted to switch now to sort of current state of affairs, how you see the ecosystem. And I wanted to start with you, Wilfred, in terms of the current state of sort of liquidity of the markets. Any thoughts on that? And then sort of around price discovery, market efficiency.
Yeah, so I think there's a post-FTX world and then before FTX, right? So I think relatively speaking, we see a lot more deeper liquidity this year compared to 2024 versus 2023. And then there's definitely improvement there, but compared to pre-FTX, we still see a lot of large prop shops in the world hadn't really jumped into the cryptocurrency space yet, just because of the fact that we're very early in the sort of a Trump era regulation, pro-business regulation, and so on and so forth. So there's definitely improvement here, but it's not. I haven't seen. We're going back to the sort of a last cycle, if you will, right? The DeFi summer and so on and so forth.
Any thoughts on the sort of prime brokerage market or what you're seeing on that front? Anyone on the panel? Or?
We're seeing more efficient solutions to net out collateral across venues, and also for borrowing against digital assets. That's always been a pain point because you can't rely on traditional financial intermediaries to hold digital assets in their balance sheet. There's all sorts of constraints within doing that. So I would say that there's more traditional prime services that are coming to market, but it's still relatively early, I would say.
I think that's tied to Wilfred's point of like regulatory hurdles, frankly, because prime business, whether synthetic we can call it synthetic or traditional, requires substantial balance sheet behind it. And realistically speaking, for those type of entities to either enter or acquire or any other M&A variation, you need the hurdles relating to regulation to be lifted. So that's probably in the works, but not quite there yet.
Maybe it's a good way to segue into like regulation, right? So one of the things that very significant for crypto, but is not really mentioned in the media is actually SAB 121. I don't know if you know the ruling, but the SAB 121, the original idea here is if banks or financial institutions want to custody Bitcoin, for instance, they have to put that as a liability and have equal amount of asset against that. This is very different from traditional custody. If you are BNY Mellon, all the custodial assets is actually off balance sheet, right? So you don't have regulatory capital constraint. So recently, with the Trump administration, SEC rescinded this order, so SAB 121. So the implication is quite significant. This means that financial institutions can custody Bitcoin, which means that the ETF in the US, at least, could potentially be in kind rather than a sort of synthetic, if you will, or a cash settlement instrument. So this is a very significant, sort of a development in the US, and this is going to be very helpful for crypto industry in the long run. So BNY Mellon, there are a lot of places where traditional custodian, they're getting into crypto. They're setting up their business right now. Yeah.
Thanks, Wilfred. Barnali, just want to get your thoughts in terms of investment opportunities that you're looking at now or that you think are worth being considered without sharing any secret sauce.
After the weekend we've had, I'm sure that the people probably will find more than that I can mention. But seriously speaking, it feels like a lot of the opportunity will come from this opening of the regulatory burden and just being well positioned for the maturation of fund cycle is going to be probably the most upside, will have the max upside potential for fund managers or investment managers. From allocators' point of view, it feels like it's the opportune time to pivot from more sort of VC private equity type of blockchain investments to more liquid and actively managed instruments. Clearly, a lot of the larger or first-time investors have gone into the Bitcoin ETF last year. We would probably see more ramp up as options are introduced and kind of they get liquidity over time period on that front. But I do think that will eventually lead to further interest down the risk curve. And away from that, I think DeFi very quietly is humming along like really, really well, especially given, I don't know if everybody saw that, but crypto had the worst liquidation in the last 24 hours, more than COVID, more than sort of like any historically. And none of these chains broke. None of the lending protocols broke or were unable to process transactions. These things are largely not reported in the media, but these are the silent spaces where I do see opportunity.
Anything to add, Wilfred or Alfonso?
Yeah. So let me just add, we run market neutral, like I mentioned earlier. In the Trump era, you're going to see more volatility. That's something that everybody expects in the market. So with more volatility, it's definitely more ways to monetize from a trader perspective, right? So from trading perspective, there's the ability to trade a lot more volume. If you're a market maker, that's very positive for you. And also ability to monetize the volatility, right? So implied vol versus realized vol, that's something that you can monetize much better in a more volatile environment. So there are a lot of things that, different dimensions of investment strategies that you can, benefit from volatility by itself. But at the same time, there's also cross-asset opportunities, right? So now we talk about, we have, Bitcoin ETF options, we have the spot market, we have the perps market, we have the calendar futures market, we have a crypto options market, a structured product market. So this is a whole symphony of markets. Obviously the markets themselves are very fragmented. So there are a lot of opportunities for very, very, very smart folks out there. I'm pretty sure there's a few guys out there really smart and can monetize all those opportunities today.
Just to add briefly, we're very excited about options markets. We've been involved in options markets for the past 2 years, but there's always been a capacity that we keep hitting as to how much you can scale those strategies. So now that there's ETF options and that we are seeing more and more market participants become active in options markets, we expect that to grow in volume over time, such that we can scale strategies, we can go further in the tenor of those options. Going beyond 6 months has been a challenge for some time. Going outside of Bitcoin and ETH has also been a challenge. So I expect all of those constraints to little by little go away as more participants become involved in that market.
Yeah, so one thing I want to add about related to ETF market is that there's no counterparty risk, right? So you're trading on the exchange, the traditional you're trading with PB, prime brokerage, like JP Morgan, Morgan Stanley, and so on and so forth, right? You're trading with the CME. All this sort of removed sort of a crypto-specific counterparty risk away from fund managers. So we see a lot of people, get into traditional fund managers, get into ETF arbitrage, basically, get into ETF and also, basically borrow, Bitcoin and so on and so forth. So there's a lot of a variety of opportunities in that space.
Perfect. Wilfred, just want to get your thoughts in terms of what's still lacking in your view when it comes to things like custody. What would you like to see in terms of changes in that market?
Yeah, I think the custody is it's very interesting. In the US, we work with a qualified custodian, but the qualified custodian is a very vague term, if you will. So this is something that I assign to the custodian. So it's not a really, the biggest problem I see in the crypto custody world is really a capital, right? So basically, really no prime brokerage. Same thing with prime brokerage. In the traditional world, you have BNY Mellon, you have all CME, which is banked by traditional bank with like 80, $100 billion, sort of like insurance fund, if you will. There's no such thing in cryptocurrency. There's no consortium of deep pocket institutional investor, put money down and to back institutional infrastructure at the moment, right? You have the hidden row of the world. You got a copper. All of them are very fragmented. All of them are, in my mind, thinly capitalized compared to the traditional world.
But I guess referencing what you mentioned about SAB 121, things may change in that space. Okay, let's switch. I'm not sure we're being told we only have, but I think we have more time. So we're going to move on to looking sort of forward. What are we expecting? I wanted to start, Barnali, in your view, sort of a lot of people talking about the merge between traditional finance and digital assets and crypto. Where do you think we are on that road, and where do you think we're going? And what time span would you put on that?
Well, yeah, I wish I had the crystal ball, but I am a big subscriber to the notion that there will be and is only one finance world. Money in whatever format flows through various avenues, but it's not like crypto is a separate market of its own and then everything else is somewhere else. So the merge is only but natural and organic. Timeline is hard to predict because a lot of it is relating to external factors like government regulation, jurisdictions, education amongst fund allocators. So those are, they will likely take some time. I think it's been a buzzword because understanding or the clear value add after, I guess, stablecoin is what we call RWA, real world asset, and that kind of like the tokenization route has been the easiest for traditional players to get their wrap their head around. I don't necessarily think that's a bad thing, but there is some challenges regarding the supply versus demand side of the equation there. All that will likely sort itself out over time as we merge and as kind of the mandate for crypto allocation becomes more mainstream. But I mean, clear path of direction is further, enmeshing. So I'm fairly optimistic on that front.
Yeah, so I think that, when we think about our merging between traditional finance and the cryptocurrency or blockchain world, there are a few components, right? So think about it. First component is more like operational efficiency. How did the blockchain improve the operational efficiency of the traditional world, right? So now we have the sort of a JP Morgan stablecoin or JP Morgan coin. We also have HQLAX in Switzerland that facilitates instantaneous settlement, right? For traditional assets. This is very important because if you run a bank, you may understand that the operational RWA is quite heavy. So if something that can be settled instantaneously, you can sort of do away with the operational RWA, so you save a significant amount of capital for the bank. So that's already happening. So JP Morgan stablecoin has been settled. There's tons of money, like trillions of dollars settled on JP Morgan coin already. On the capital market side, for instance, the Bitcoin has been around being a commodity, at least in the US, it's through the ruling called coin flip and the CFTC about 2015, around that time frame. So that's Bitcoin now becomes sort of a reserve currency for the corporate treasurers. You see there's a website that you can exposes a bunch of companies that holds Bitcoin. So this is already by definition a part of the sort of a traditional finance or traditional world asset class, all right? But it may not be some meme coin or Trump coin or banana coin or whatever it is, but Bitcoin itself definitely is standing out as a sort of the reserve asset for a lot of companies already.
Alfonso, any thoughts on that?
Just to add, I think it's still very early in that timeline. We're still referring to securities that we issue on chain as real world assets, which to me makes no sense because we think of real assets and financial assets. But the fact that these assets that are onboarded into blockchain networks are referred to as real world assets suggests to me that there's still a disconnect between those two worlds that hasn't really been bridged yet. If we look at the value of real world assets today, that's around 20 billion. If you ask Larry Fink what he expects in terms of tokenized securities down the line, he thinks it's going to be pretty much the entire range of securities. So there's still a big gap in terms of some people's expectations and where we're at. I think it's very early days.
Brilliant. Well, I think we're at time, so I was going to end with price predictions, but I think we've run out of time, so we're going to call it there. Thank you very much to our panelists for sharing their views.